In 2005, a hedge fund managed by Michael Burry identified a weakness in a specific asset class, the US housing market, investing large sums of money short in the market. That move went down as being one of the best trades in history, and the story became so famous that a film, The Big Short, was made about it. Fast forward to today, and history could be repeating itself again, but this time in a different area of the economy. A number of hedge funds are betting big against a certain subsection of the stock market, investing millions into shorting it, potentially making it the next big short. ESG, which stands for Environmental, Social and Governance, themed stocks and funds, specifically green energy stocks, are being heavily targeted by short sellers right now, who are mounting an attack on the sector because they believe that many stock valuations have become bloated as a result of the green hype. Now, this all stems from the Inflation Reduction Act that was signed in August of 2022, which could end up channeling up to $3.3 trillion into renewable technologies and other green assets over the coming decade, almost 10 times the amount initially indicated by the US government, according to Goldman Sachs. Now, in the first half of 2023 specifically, global investment into renewable energy did hit a new record of $358 billion. Along with this, ESG funds became very trendy and popular in 2020 and 2021, with many new investment funds popping up every month that were ESG themed. Now, BlackRock, State Street and various other large money managers have been rolling out these ESG funds for a number of years, aiming to capitalise on the growing trend of sustainable investing. So why exactly is the ESG sector experiencing mounting short sale interest, with a large number of hedge funds increasing their bets against this market? It can all be explained with three main reasons. First and foremost, the large investment giants like BlackRock and State Street have done a U-turn on their ESG fund strategy and are starting to wind down a portion of their ESG products in dramatic fashion. Now, more than 24 ESG funds were unwound this year by State Street Corp, Columbia Threadneedle Investments, Janus Henderson Group, and Hartford Funds Management Group, among others, according to data from Morningstar. And on September the 15th, BlackRock did alert regulators that it also intends to close down 2 sustainable emerging market bond funds with $55 million in total assets. Now, investors have pulled more money from the ESG funds throughout the first half of the year than they have put into them, and more sustainable funds in the US have closed so far in 2023 than in the prior 3 years combined. After the hype that these ESG funds generated in 2020 and 2021, when many of these funds were debuted, regulators began to take a closer look at fund labels and recently published rules to guard against misleading or exaggerated ESG claims. Now, the SEC has become more aggressive with greenwashing, penalising money managers that don't live up to their own ESG marketing claims, using existing rules against fraud. Now, Associate Director for Sustainability Research at Morningstar, Alyssa Stankiewicz, said, "We have definitely seen demand drop off in 2022 and 2023. She added that the closings underscore shifting fortunes for sustainable investing as returns disappoint investors and anti-ESG rhetoric does persist. Now, also, BlackRock CEO Larry Fink did also stop using the term ESG altogether earlier this year, stating that it has become too politicised, and instead he did discuss investments tied to the transition to a lower carbon economy. Ultimately, the hype bubble around ESG stocks and funds has burst, and there is even now political backlash and scrutiny from investors around some of these funds. With investors selling up and large funds starting to be wound down completely, capital is rapidly flowing out of the ESG sector and will likely continue to do so, which is obviously having a negative impact on many stock prices. So the second main reason is that the Inflation Reduction Act has artificially boosted the business performance and consequently the share price of many green energy companies with short-term subsidies and cash injections. Now, handouts stemming from this act being passed are not going to last forever, and in many cases are only short-term. Now, Renaud Saylor, the CEO of Anaconda Invest, does believe that it has become clear that climate stimulus has contributed to the correction currently taking place in the solar sector. He says that solar companies have been completely inflated by the Inflation Reduction Act, and because there wasn't a lot of liquid good companies, people poured money into them and the valuations became far too high. Shares in Maxion Solar Technologies are down about 50% since July, and short interest relative to shares outstanding has risen to approximately 6%, which is up from the 3.5% it was in June. And similarly for SunPower Corp, shares are down about 30% since July, and short interest has soared to 25% from around 10% at the beginning of the year. Even looking at the performance of the largest solar energy stocks, which are amongst some of the biggest holdings within the most popular ESG funds, performance has been rough in 2023. Now, funds shorting both Enphase Energy, the solar battery storage manufacturer, and Solar Edge Technologies, the inverter maker, have collectively profited roughly $1.5 billion so far in 2023. And even hedge funds that have strategies dedicated to supporting renewable energy have acknowledged the fact that there are some companies and subsectors that are out there right now that are weak and overvalued. Soren Arndal, the founder and chief investment officer of Texas-based Blue Orca Capital, does say that the great shorts just happen to be in the ESG space and that bloated prices can be found all over ESG. He also added that he didn't set out to target ESG funds specifically, but they clearly see a number of short opportunities in the market right now. A couple of examples of stocks that are currently being shorted by Blue Orca do include Enviva Inc., a biomass fuel producer that has an ESG rating of A at MSCI, with the stock being down almost 90% this year after suffering losses amid reported maintenance and operational issues. And also Lee Cycle Holdings Corp., a battery recycling SPAC, whose market value is down approximately 20% this year as lithium and cobalt prices did fall. There are even a number of companies that are facing potential removal from major clean energy ETFs due to no longer fulfilling the market cap and liquidity requirements to be retained as part of the ETF. The third main reason why hedge funds are short in ESG stocks is the current macroeconomic conditions we are facing in the economy right now being very unfavourable for the sector. Now, interest rates are extremely high right now, which makes borrowing money much more difficult and expensive to maintain compared to a couple of years ago. Now, the problem is that many green energy companies are not yet profitable and won't be profitable for many more years, and this includes many of the stocks that are featured in the most popular ESG funds today. Even those that have started to make profit still do require funding of some sort to sustain the level of growth that they are aiming to achieve that investors are also expecting. And taking a look at this chart from BNEF showing median cash flows of clean energy companies, we can see that the free cash flow remains negative and in fact is now an even deeper loss compared to just a couple of years ago. Growing capex is also contributing to this negative free cash flow, and BNEF does estimate that even the industry giants are being forced to increase their spending. Chinese electric vehicle maker BYD capital expenditure is up 113% per year since 2019, while Tesla's capex is up 75% in the same period. Alternatively, raising fresh capital through investment funding rounds is also quite tough in today's market due to there being less venture capital money floating around compared to in the past. And of course, all of this is not good news for the companies that need funding, as it is more difficult to obtain this funding and more expensive to maintain it going forwards, which greatly impacts the ability to continue growing and developing as a company. ESG stocks do also require individuals and businesses to consume their products and services in order to continue growing and for the stock to perform well, which often requires the help of government subsidies and incentives, as mentioned before. Now, US debt is at an all-time high, and the US government is spending more than they ever have done on interest payments for the debt that they have borrowed. Now, there is not enough income being generated from tax at the moment, so investing a load of money into green energy incentives and subsidies for businesses and consumers is absolutely not a priority for the government at this moment. Now, this is likely to remain the case for the foreseeable future, and without the help of the government, it does become harder for ESG stocks to perform well. The US consumer is particularly weak right now as well, with the savings rate being at historic lows, credit card debt being at all-time highs, and the cost of housing and general cost of living being so high today that many Americans are struggling quite a lot. Likewise, many businesses are having a tough time thanks to the current economic conditions, and therefore don't have a ton of money to invest in the growth of their business or new green energy incentives right now. With green energy products and services simply not being a priority right now for the government, businesses or household consumers, there is a noticeably weak demand on the market to help these ESG stocks. We've also still got the looming supply chain problems and bottlenecks in some cases that are impacting production of green energy products. Ultimately, this is all going to negatively impact the business performance and therefore stock price of many ESG stocks who are struggling in the current economic landscape. So when you consider the fact that many large investment companies are winding down their ESG funds, how bloated many green energy stocks have become thanks to the Inflation Reduction Act pumping money into them, and the macroeconomic conditions being very unfavourable for many of these companies, it's really not looking good for the entire ESG sector today. Add into the mix the rising short interest that is brewing in the market, as well as potentially even more ESG funds closing down, and what hysteria this could add to the market when word spreads. The bonfire that is ESG stocks could have more fuel added to it going forwards. Are we about to witness the next big short take place? Leave your comment down below on what you think. Another asset class that could be in real trouble over the next few years is real estate, with the housing market poised for a terrifying collapse. I go into more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like on the video and subscribe if you enjoyed it. That does help out the channel a lot, and thanks a lot for watching.